Garrison Snell, welcome to Acquiring Minds.
Thanks for having me.
Garrison, you're about 5 years and 5 acquisitions into a career that you're pretty sure will be buying businesses for the next few decades. This is the dream career for many listening today, and you're young. You got started early on this path, so let's hear how you're doing it. Start us off, please, with some background on you, Garrison.
Yeah, I guess I technically am still young. I turned 30 last July. I'll be 31 this July, and I don't know. You turn 30, and I think everybody suddenly thinks you're an old man. I don't know what it is, but
well, try turning 40.
Most of my friends are in their mid 40s and going on 50, and they're like, you're really young, dude.
Yeah.
I started a small company in the music industry when I was 20. When I was 20, I was at Belmont University, and Belmont's a music school mostly. It's a great music business program, and I wanted to help artists with their marketing and started a little marketing agency, and it did well. There was a gentleman out of New York who was doing a hub and spoke roll up of these agencies, and decided basically that he wanted to buy us and a few other companies. I was 24 whenever we closed that. I had been married like 4 months, and I was living in a little, probably, I think it was like maybe 600 square foot apartment on 8th Avenue in Nashville. By the way, I'm based in Nashville, Tennessee. It's where our headquarters is. Mm-hmm. And my wife and I, we come from a Christian background, a faith background, and we said, hey, we want to do some good with the money. I'm the first one in my family to graduate from a 4-year university, and I'm from Arkansas originally. And that transaction gave us the capital to start what we see as a permanent holding company for buying family businesses, keeping them forever, and loving on the people, the employees, the community through the proceeds of the business and the activities of the businesses. So yeah, like you said, we've bought 5 companies since 2000. Well, we started the company in 2018, bought a few different things, and then started buying operating companies in 2020, and have bought 5 companies since that point, 4 of which are heavy manufacturing, as you know, and 1 of which is in financial services and trust administration. So,
and so the restaurant was 2020, or was that 2019?
Yeah, I'm sorry. The restaurant was actually Christmas of 2019. So
okay,
yeah, it was right
really
there.
Close. Yeah.
Gotcha. I think we took over January 1st of 2019, and I don't count the restaurant today because we since have sold the majority to somebody else. But technically, six acquisitions.
Okay. Great. Thank you for that. And we'll hear a little bit about the restaurant as well, and the real estate, which came before it.
Sure.
But before we get into all of that, Garrison, so say a little bit more. You were at Belmont. It's a music school, as you said, in Nashville. You actually went there entertaining the dream fantasy that you'd be a musician?
Yeah, my dad's a bass player. I grew up with him in bars, in music venues, helping him with sound equipment and setup, and I was a drummer. So I was I guess you would call an all-state jazz drummer in Arkansas. Mm-hmm. So I went to the largest and kind of most well-off high school in Arkansas, and I had a great music program. And I didn't have any interest after high school other than playing music, and I was not good enough to have that dream. So I got to Belmont very quickly and realized, oh, this is hard. There's a lot of... But
this was one of those things where you thought you might have been the best drum player you knew, give or take, in high school.
Well, not the best that I knew. There was a couple who were fantastic beyond me, but I thought good enough to make a career out of it. And the truth is, I didn't have many interests beyond it at the time. It was just something I had connected with my dad on, and it was what I did as, I guess, a primary extracurricular. And I know it sounds kind of weird, but I didn't have a lot of ambitions beyond just trying to do something independently for myself, and music gave me that outlet for many years.
Mm-hmm. Well, the independence, there's a through line. Actually. So, but what's the experience of having a dream and really not, you just said, not having really any other interests or ambitions, and then frankly, the dream shatters early on, I guess, in your exposure to kind of the big leagues or the next level up?
It was it was such a stark reality of how far the competition was ahead of me when I arrived at Belmont that I said, I can't even be upset by this. This simply is just a reality. So what happens? I got to Belmont in 2011, and I began looking at my peers and realizing, oh my gosh, these guys are incredible. And then I learned more about what the life looks like on the other end of that. And I wasn't sure it was ultimately something I wanted. So I don't know. Maybe it was, there was some moments of sadness for sure, but mostly there was a realization of, I don't think this is the life that I want. I'm not really sure what it is that I want. So I'm just going to begin to help artists as a manager and a marketer and just work with students in and around campus. And I set up a little company at the time to do that when I was a freshman at school. But it was sad. I still enjoyed playing, but
it wasn't maybe as devastating as it might sound, because it was just like
no.
so obvious that
It was so
that
obvious.
it wasn't.
Yeah,
it wasn't gonna happen.
so obvious. You're like, just don't even try, man. Like this is not gonna work out well. I became a little disillusioned by the idea that when I reached the 10-year, 15-year mark of putting in the effort it takes to make a career out of this, I might be at the point where I would like children and a family, and I might have selected a career that would make that difficult. So it was a conscious choice.
Yeah. Okay, and then so freshman year, then you start the agency.
Freshman year, I started a management company to work with 4 independent artists, basically saying, what do you need me to do? How can I help your career? Let me book recording studio time for you, find you little shows to play, do your website. And then when I was 19, I got connected to a guy who was working with Ronnie Dunn of Brooks and Dunn, the large popular country duo. And so I ended up doing the marketing work for Ronnie's independent record label from the time I was 19, or I guess I had just turned 19, for about 2 years following that. And that was what turned into the agency. So that work with Ronnie turned into me setting up an agency to do it for other artists. And
in that getting that work with Ronnie in the world of country music, being a 19-year-old, that would have been a big deal. That would have been an incredibly exciting opportunity, I assume.
Yeah, I mean, I owe Ronnie, I owe Ronnie a large, significant chunk of what I've accomplished today. He bought me my first laptop. He put me in his house and said, I'll pay you to figure out how to do this. You're smart and compelling, or whatever he saw in me, and thought, I'll essentially sponsor you into doing this if you'll help me figure out how to do it. And we had a really good time. It's hard, it's expensive, and he decided that ultimately I think there was a better situation for him, and they decided to go do a Vegas residency after that, and then he ended up signing with a classics imprint called Nash Icon of Big Machine Records. But I did that for about 2 years with him, and I wish that like the value that was created out of that one laptop purchase in 2012 to when I bought a new laptop in like 2020. I mean, it's insane how much value is created, and I owe that to him.
And then so the agency, you parlay that into an agency and eventually sell the agency. Can you share, you've said that the money from that exit was significant enough that it caused you to contemplate what you were going to do with it. So it must have been more than just a token amount. Can you give us a sense of how much it was, or? Yeah,
sure. It's all relative, obviously. But at the time, after tax, it was about $500,000, about $500,000. And I was 24. And to be honest with you, to my knowledge, that's the most money anybody in my family has ever seen at any one point in time, ever. And my wife and I, she was working for a nonprofit, and we were living very, very frugally in this little apartment, newly married, and we're staring at this amount of money, thinking, "Wow, we could hang out for a long time." And, we don't have to. I mean, yes, you're gonna have to work eventually in your life, but that's, at the way we were living, that's 8 to 10 years of salary right there that we were living off of, And we decided instead that we wanted to invest and try to do some good with the investments. Like I say, in a way, a life-changing amount of money, but not enough such that you're retiring forever, especially not as a 24? Yeah, 24-year-old.
So. Right. Well, with wealth, there are many tiers between having no money and being able to not work ever again if you don't want.
Yeah.
But each of those tiers is still quite significant, and life changes all of them. And it sounds like you got to the next, or maybe skipped even a few tiers from zero to $500,000 post taxes at age 24. Not bad.
I mean, I was very happy with it. So, I was like, I will take that deal. That's fine.
Well, but I know where this story is going. You were happy with it, and then you weren't. We'll get there.
Yeah,
but just before we do, Garrison, the becoming an entrepreneur. So you were going to be a drummer, then you weren't, and then all of a sudden you're this hustler who is kind of trying to just kind of be the quasi manager for other Belmont students, I assume.
Yep.
There were other Belmont students. They weren't even. So where did that energy come from? Were you always a lemonade stand kid?
I was not always a lemonade stand kid by any means, but I did have little side hustles. I had a small lawn mowing business, obviously, like a lot of kids do. I think I had 10 lawns maybe when I was 16 and 17. And I had put together a couple things in high school that were, I guess you'd call them independent projects. I started a Battle of the Band series at the high school that would raise money for VH1 Save the Music, and I was really involved in Boy Scouts. So I'm an Eagle Scout, and both of my brothers are Eagle Scouts, and it's quite good leadership training, I think, and principal leadership training, and there's a lot of independent thought and independent work that's done in that. But the truth is, like, being a musician and what I guess you'd say, like, the hustling side of it is not too dissimilar from, I think, starting a business. It's at least that's
I've never heard that comparison.
Yeah, that's the way I experienced it. I mean, you have a view on the world and a particular flavor of something that you want to do, and you have to go convince folks that you got some value to contribute to what they already do, and it requires a lot of networking and a lot of interactions, good positive interactions with folks, and it requires the ability to be highly emotionally intelligent in social situations and rooms. It's kind of a weird, I don't know how the best way to say this, it's kind of a weird political, the way people make decisions, at least of who they're going to play music with, is, are they a good hang? Do they like spending time with these people?
Yeah.
And so there's a natural, like, if you can become warm and ingratiating and ask for the right things and offer the right value, it ends up moving a lot smoother.
Sure.
And honestly, maybe I'm better off saying being a musician isn't that far off from being someone who's in sales, which is,
I was going to say, that was the word I was waiting to hear. Yeah.
Yeah. Which is, a key function of getting something off the ground. But
exactly.
Yeah.
So
I enjoyed the heck out of it. There were some definite skills translations. And I have a little bit of a natural proclivity for that. My dad is similar. So, I wasn't fully translatable, but it was enough.
Now, jumping back forward again to the exit, $500,000 after taxes, you're 24, feels good. Then what?
Yeah. So my wife says, Garrison, you really you've never been successful in anything you didn't have your heart in. So the ability to just do it for the money alone has never been enough to really get me going. When I sold that business, I really believed in what we were doing. Okay, so I really believed in the fact that we were using modern digital tools to help independent artists grow their careers for a price that was accessible to them. And in my mind, it was me kind of helping my dad and helping what he did when he was my age. He came to Nashville and was in a band and tried to do very well and ended up not. And I traded that mission for money. I traded that mission for some money, and so I woke up with some money in my bank account and not a reason to get up and go to work. Nothing to do, no mission, and almost, I would say, very little purpose. And for some reason, that hit me really hard. I'm just built that way. But I experienced a pretty significant, depressive period around, why did I do this? What's my mission? What's the purpose? Like, what's this for? What's this about? How do I help? And I reached a point where a friend of mine told me, he said, Garrison, in order to stay happy yourself, you got to give the happiness back. You got to give it away. And so Snell Ventures, the holding company, is set up as an extension of, it basically says we're going to use the good that we're given, the resources we're given, to do good for others in a sustainable, permanent, long-term way. And it gives me a purpose. It gives me a mission. And that's a lot more enjoyable to me than the smattering of financial security that I had. I just didn't feel very strongly that the financial security mattered as much as the mission did. You know, so I don't know. It's just the way I'm wired, and for better or for worse.
Well, it is interesting, Garrison, because I understand existential crises. They usually come later in life, and they usually don't hit so soon. It sounds like you were only able to enjoy your newfound wealth very briefly before a crisis set in. So anyway, it does seem like there's something about your personality that might be a little bit different, because you do hear that people, after they have a windfall, it's exhilarating, and then then they can kind of go into a funk. So maybe this is just that pattern, and you just experienced it earlier than most people would.
You know, relatively speaking to a lot of exits, relatively small, I experienced about an hour of elation. And I remember where I was sitting. I was sitting at Soho House in LA with one of my marketing clients, and it went through, and I was looking at the bank account, and I was like, holy crap, life's good. And then about an hour later, I was like, what am I going to do tomorrow? Like, what's the point? You know? And it hit me really quick. And
yeah, exactly.
You know, I'm okay with that. I find it as a good motivator.
Yeah, no, well, it sure has motivated you in a really compelling direction. Okay, so you just said a couple of minutes ago what kind of the mission around Snell Ventures is, but how did you arrive at buying businesses? There is essentially, the risk of putting words in your mouth, you're generating wealth so that you can then kind of plow it back into good work and help the communities in which you operate, help the employees in which you operate, just kind of all the goodness that comes in, you just amplify and send right back out. Fair?
Yeah, that's what we're trying to do.
But there are many ways. Maybe you could have started a nonprofit. Maybe you could. I mean, there's 100 ways. Buying businesses is an unusual, non-obvious way. How'd you land on that?
Well, the first thing was, it was obvious to me that $500,000 wasn't enough to do the amount of good I want to do. My little personal motto is maximum good for maximum people. And if I'm going to spend my life doing something to help others, I'd like to do it in as large and permanent a way as possible. But I've always personally, so I've always connected with the idea of the small business, and it kind of logically makes sense. So they're usually, smaller companies with a small ownership set and a very intimate relationship with their employees and the families attached to it, in a town where they know what's going on. They know what the high school needs. They know what the Boy Scout troop needs. They know what's going on in the local churches. They know which families are struggling, which families are going through divorce. They know where the addictions are and the illnesses are. And they know where all that is. And they are one of the few entities in all those communities that can direct their excess how they would like. All the owner has to do is decide that that's what he wants to do with the earnings. And so there's an owner or two owners or a small family. And almost all of these businesses we buy have some element of that already. They've got some sort of support fund for the employees, or they hear of a surgery that needs to happen, and so they write an anonymous check to the local church to then pay for that surgery. Or like, they're already directing their excess in ways that help others. All I'm doing is saying, hey, you've run out of the next generation to do that very thing. I'm going to take it and steward it for the rest of my life. I'm going to make sure it continues to do that for the rest of my existence. And that's why we don't intend to ever sell anything we own. It's just a real compelling, in my mind, a real compelling entity in society that says that little business can decide in a unilateral fashion what to do with its excess, and it knows it has an informational advantage in that it knows what's going on in the lives of its people, their families, and that immediate town. So it's to me, it made the most sense that if I bought one of those companies and said, we're going to do that forever, you could probably do a lot of good over time.
So there's not just, there's kind of a two-pronged strategy here. It's not just generating wealth so that you can send wealth back out into the world. It's also, like you said, this informational thing where you're buying businesses that have a finger on the pulse of their communities. So where and how you deploy wealth, you have this kind of this information edge to do that in a really great hyper local, personal, community oriented way.
Yeah, I'll tell you a quick little story about one of our companies in Bradford, Tennessee. It's a small town, probably 2.5 hours west of Nashville, just off the highway in a rural community. And that plant has been there since 1909. And the the lady who runs the front desk has been there since she graduated from the high school across the street when she was 18. It's been 40 something years since she walked across the street and went to work. The guy who's in QC graduated the class behind her, I think, or the class before her, maybe. The longest tenured employee lives literally across the street. And when I showed up and bought the business 4 years ago at this point, I said, hey, when you hear of something that the community needs, let us know, and let's put some money in place for you guys to meet it. They came to us, I think it was 2 years ago, and said, hey, the high school's Future Farmers of America needs a new fence and a new kind of polish of the facility that's over here. Can we send some money that direction? Yeah, absolutely. And so, I mean, they feed us, and then we in turn give them the capital to go and find those things. Trying to think of another really good example. We did some renovation work on one of the high schools in one of the communities. Things like that. And we don't hear about all of them, but every employee at the company or every department has at least $1,000 to give away every year to some need in their community. So, we have 200 something employees at this point. And we typically do it by head. Some of our businesses choose to do it by department, but they can direct that money and say, hey, I heard that so-and-so needs help. I'm going to use my allocation to go and do that. Does that make sense?
Yeah. It's really cool. Okay. Well, let's fill in the gaps here and hear the story. So you decide this is the way. You don't buy business first. You look at real estate as many people do. So tell us quickly about your real estate adventures.
Yeah, it's barely an adventure, to be honest, but it's I knowing nothing about investing. I simply said, what do people do? And I hear people buy rental properties, so I'm going to go explore some rental properties. I had this thesis that Chattanooga sits, a couple hours between Nashville and Atlanta. It's very tech forward, it's a very outdoorsy community. There's a lot of compelling reasons why you might want to leave Atlanta and Nashville and go live there. And so I called a friend of mine and said, hey, can you look for properties for me in Chattanooga? Ideally, they're properties that we could then rent to low-income families or folks who are transitioning from recovery programs or homeless shelters. And we found 11 units down there in the span of about 4 months, bought them, and then dedicated them to various organizations in the city who put folks in it. So the initial thesis was folks who are transitioning out of homeless shelters or folks who are transitioning out of recovery programs or coming from other cities, they can live in our homes. And in most cases, the city will pay most or all of the rents. And so we generate about a 15% return on our cash every year out of that. And we've housed in the last, since 2018, 35 or 40 different families, something like that. Most of which have gone on to live in more permanent situations. But it's great. We still have the portfolio. I decided I like the operating businesses better. I liked working with the employees and learning about the companies, and I like that better.
Given that by your own description, you didn't know anything about investing.
Yeah.
How did you learn that buying an operating business would be a good alternative or an alternative to buying more real estate?
Well, I mean, I had a little bit of just practical, personal experience from the company I built. I just said, I like working with the people. I like the competition of determining what they're doing and what we can offer and the value proposition to customers and sales. And I like the activities associated with the operating company better than the real estate.
Yeah.
But from an investing standpoint, I knew absolutely nothing. And I just said, well, what do the best do? And so I immersed myself, similar to Raphael and those guys, very immensely into Berkshire and Buffett and Munger, and have attempted to emulate for the last 6 years exactly what they might do with our small amounts of capital. And so we run Snell very similarly, but our investing definition is it must promise the safety of principal, and it must generate an adequate cash dividend annually. Adequate being greater than 8% or better than the alternative, better than the safest alternative that we know of. And we try to buy things that we understand and try to buy things that we have shown persistence over many years. Our oldest company is 115 years old that we've bought, and they've shown quite a lot of persistence. So the real estate, it's awesome. We love having them, but it was my first step towards trying to figure out how you both do good and have a great economic return in the same package. And that was, I don't regret or dread any of those activities. I just like the businesses better. They're just more fun.
Well, then why was the second attempt to invest in something a restaurant? Where did that fit in?
It's a great question. Why was that? So once again,
by the way, I just aired an episode last week of somebody who bought a restaurant. It's been a phenomenal investment. So despite the fact that restaurants are, we talk about how they are one of the least attractive businesses to buy. Jarrett Burke in Hanover, New Hampshire is making it work. So. But go ahead.
I saw the teaser for that one and thought, yeah, that might work. A friend of mine, when I told him I was going to buy this business, he's like, Garrison, what are you doing, dude? And he was thematically right, okay? And I know you've heard this a few times, but there are certain businesses, restaurants included, they just have so much love and loyalty, and are in such a unique situation that you can see what the moat is. You can see why it's defensible. And this was one of those. I definitely got some things wrong in my assessment of the business. So I can wind back a little bit, but basically, the restaurant was one of Nashville's oldest restaurants. It was founded in the 90s, and Nashville has gone through a ton of change. A lot of local places are gone. And this place happened to be located in a very unique 8 or 10 unit strip center smack dab in the middle of a neighborhood. So it was not a strip center what you might normally visualize. It was kind of this older, cobbled together, very, very cool looking strip center next to a very popular bar and a popular boutique, and across from an even older family restaurant, surrounded by one of the oldest neighborhoods in Nashville, one of the wealthiest neighborhoods in Nashville. So this place was the date spot for all the old legacy Nashville locals. And the gentleman who sold it to us was wanting the next generation to preserve the business. And we bought it from him for a fantastic price. And then COVID hit within 4 months. And we found out that the community really does love this restaurant. It was one of the few that there was so much, this 30 years of loyalty for, that when we texted them and called them and said, please buy our freezer meals and please buy our lasagnas and stuff, they bought them in bulk, and they said, whatever we can do to help will help.
Oh, fantastic.
Yeah. So that's what I thought was there. When I first looked at it, that's what I thought was inherent in this one. And we got to test that thesis really quick. One of the things that I thought was really good that wasn't, it turned out to be a double-edged sword, was it's small. It's like 60 seats, and it has a pretty small kitchen. And I thought, well, that's great. We only need to staff 1 or 2 people. It turned out that I overestimated people's willingness to work full-time in a kitchen, especially a high-volume dinner kitchen. And so there was we had a lot of turnover at the cook position and the kitchen lead position, when I thought it would be easier to staff that. I didn't logically obviously think, well, they might want a few evenings off to hang out with their family, and then so the fact that it was small actually became somewhat of a disadvantage, which if it was bigger and had a little more volume, then we could have spread it out among more people, and we would have been less dependent on 1 or 2 cooks. Does that make sense?
I see. Because it's small. It's too small to support multiple cooks.
And so so if you'd had a kitchen twice the size, you could have staffed a really nice part-time schedule for 6 or 7 guys, 6 or 7 men or women back there. The kitchen size that we had, you needed basically 2 people at maximum, maybe 3, and there wasn't enough. I guess the best way to say this is there wasn't enough hours to spread around
Yeah.
to get some folks who were interested in staying a long time, and there was too many hours needed to really convince anybody to be there full time. You see what I'm
Yeah.
saying? It was kind of
Yeah.
this dead
Yeah.
zone where we needed just a little more capacity to make everybody's lives a little more balanced.
Gotcha.
So, lessons learned. But the love of that thing, that was, people love it, man. And it's what we realized it needed somebody who was going to be in there every day. It was not a fit for a holding company, specifically a passive, decentralized holding company. So I sold 90% of it to a local family whose son is a restaurateur who's in there every day running it, and we still own 10% of it and participate in the business with him. But
And while you owned it, and it was the only thing you owned, I mean, you had your units in Chattanooga, but this was your first operating business that you
Yep.
acquired. Were you in there all the time? How were you spending your time?
It's a great question. I was in there pretty much every day, if not every other day. And then my director of operations, who's been with me since month 2 of the business, she was in there pretty much every day. And because she used to live here, she now lives in Florida. And she was in there every day. We would work shifts. We were just trying to learn the business.
Yeah.
But actually, I spent the majority of my time when I wasn't there looking for other companies. And I found the 2 manufacturing companies that we bought in June of 2020 about the same time that I found this place. So, we only owned the restaurant for 6-7 months before we bought our manufacturing companies, the first 2.
Okay.
So.
Okay. And just, okay, well, let's hear about those 2 acquisitions, and then
Sure.
we'll come back to how you're buying these businesses, how far this $500,000 is taking you. I guess you've already said, though, that the restaurant was kind of a screaming deal. You got it for a really low price. So
yeah,
okay.
It was. And I'm not, for the purposes of the folks in the community and the folks that know me, I'm not going to share what we paid for it, but it was a very, very good deal. And I've noticed through all the deals that we've done, the sellers who really connect with why we do what we do will often want to accommodate us on terms and price in order to get it to somebody that they know is going to take care of it.
Mm-hmm.
So, so the 2 companies we bought in 2020, one's called New Deal Trailer Parts it's just north of Nashville. They've been around since 1955, making trailer suspension mounts. So if you look at a utility trailer pulled behind a truck, you look at the axles, they're hung, the axles are mounted to the trailer with these things called leaf springs, which are just springs. And those springs are mounted to the trailer with these U-shaped brackets. And there's only 3, maybe 4 companies in the country that make those, because they're very thick metal parts, so they require a lot of tooling to make, but there's not a lot of, they're pretty price-sensitive parts. It's not like a desirable end market. But this company owned 150-something sets of tooling for a wide variety of parts, and the seller was in his late 70s, had 7 back surgeries, and was at a point where he really wanted to get out of the business, but hadn't met anybody that he thought was aligned with his way of doing things. Met me, and then made us a very, very good deal. That business is and was quite small. It was doing maybe 1.4 million in sales and 300,000 of earnings when we bought it in 2020. By the end of 2021, it did 7.8 million in sales and about 2 million of earnings that year. Yeah, do you want to hear that story? I'll be happy to tell you that story. It was
well, I do, but
Yeah,
but
it was insane.
let's hear about the other acquisition, because it happened right around the same time.
We
right?
did it at the exact same time. It's the same deal, 2 different families, the same loan package, and the same bank, but 2 different businesses acquired at the same time. They're called Quad Industries. They were the one in Bradford I was talking about earlier. They make what are called Babbitt bearings, and Babbitt bearings are a very old technology. So Babbitt is a type of molten white metal. It's made out of a bunch of different types of metals, tin, lead, a few other types of metals. And it's put inside kind of a U-shaped metal shell. And then that shell goes around these shafts, so big reciprocating shafts that generate energy, usually used in highly corrosive environments, but where a steel ball bearing or roller bearing is too expensive. So Babbitt's been around since 1880 as a formulation, and has been in play for a long time, still very much in play. GE uses a ton of very large Babbitts. I'm talking 60, 72 inches in diameter Babbitt bearings in a lot of their equipment. National Oil Well uses a lot of them in downhole drilling and oil wells. Uh, Turbines, air compressors, and we're the only national manufacturer of Babbitt bearings under 21 inches in the country at this point. Mainly because you can, if you want to buy large quantities, you can import a lot of them a lot cheaper. But for those that want 1 to 10 to maybe 25, and they really, really care about the precision, you have to get the Babbitt and the cuts within plus or minus 3/10,000ths of an inch. So take an inch, cut it into 10,000 segments, and you've got to get the precision of the dimensions they require within plus or minus 3/10,000. If you really worry about that, Quad's probably the only one that can do it in that size. And there's a couple reasons for that. But so we bought those two at the exact same time.
Quads, and what did Quad look like on numbers?
1.8 million of sales, 400 in earnings. It'll do 3.5, maybe 4 million this year, and 750 to 900 in earnings. I paid $1 million for Quad, which included the real estate, and the real estate was appraised at $550,000. So the total deal, I paid $450 for the business, and then I paid $900,000 for New Deal. So roughly 3 times earnings. The total financing was the total deal was 1.9 million.
Oh, sorry, you bought two different businesses from two different families, but one single loan?
Correct.
How did you swing that?
I used an SBA loan, and I told them this is what I want to do, and they said okay. I mean, basically, yeah.
Interesting.
We talk about it. There's not a lot of detail other than I showed them what we were trying to build. I showed them why we were doing it. I showed them the management was in place, and that it was within 2 hours of me, and that I was willing to go back and forth and do whatever would satisfy their requirements. And there was an SBA lender who loved it. So.
Interesting. I'm not sure I've heard that before, that somebody did an SBA loan for 2 businesses, but 1 loan.
Yeah, it was 1 loan. They blended Quad's real estate into the deal, and so it amortizes at 19 years. And we leased the facility for New Deal, but we own all of our other facilities, which we have 5 facilities right now. So it's, we like to buy the real estate. But yeah, I thought it was unique as well, but this particular lender was all about it. So.
And how are you able to get such a good deal on Quad, where the business piece of your $1 million acquisition price was $450?
I asked myself
the business
this
was
all
generating
the time.
$300 to $400. So you paid less than 1.5x.
Yeah, I asked myself this all the time. The truth is, the gentleman who sold us the business was one of 4 partners left in the business. Everybody else had passed away. He was the CFO, controller, and accountant, and was experiencing some health issues. And I asked him to tell me what was his price, and he said $1 million. And I said, "Can I have the building as well?" And he said, "Yeah." And he viewed the business differently than I view it. He viewed it, and we can talk about this with the Porter's 5 Forces stuff at some point. But he viewed it that the suppliers to Quad had too much influence and ultimately too much dependency, and therefore it would be really. He told me. After we closed, he said, "You'll be out of business in 3 years." And I said, "I don't see it the same way." And neither did the
After
employee.
you closed. That was nice of him.
Yeah, I'm not, yeah, enough said on that. But we didn't see things the same way. And so far, we've been proven out to be correct. There's a decent possibility we could be wrong in the future. I don't know, but our gross margins on that business are about 65%. And it has a ton of pricing power, and it's a really nice business.
And the risk that he saw, that why he thought the business would be defunct in 3 years, did you perceive that in advance and decide that it wasn't as you were comfortable with that risk, or had you not even seen it? So
No.
So
I knew it. Yeah, I knew it was there, and
he just thought it was existential, whereas you didn't.
Yeah, correct. Yeah, and like I said, part of that might have been naivete. This is 4 years ago. I was just kind of starting our investing journey, but I was looking very naturally at dependencies. And what I didn't know is that's basically Porter's 5 Forces. And one of the key dependencies that Quad has is if they're going to make bearings of a certain size, they have to buy steel coil with Babbitt laid into it already. There's only a few people who do that. And specifically, there's a company in Michigan, in Detroit, called Federal Mogul, and they make a lot of bearings, but they make similar types of bearings for the automotive industry, and they were selling us material. They announced a year into the acquisition that they were no longer going to make that material, and that we had to put in a final order, and that was what he was worried about. What he didn't do was go look for other suppliers, and we found a couple other great suppliers overseas, and we import in that material and then warehouse it and cut it up. And what we would like to do very shortly, and we're going to put some capital into it, is bring that in-house. Our facility is about 90,000 square feet, and we use 45 of it right now, and the other 45 is empty. And the goal is to put a babbiting line in that side. So we're getting to the point to where we can make that investment. But I thought it was very likely, given how useful these bearings are, that there's going to be somebody else on the planet who's going to put Babbitt on steel. And I went and did a little bit of research and found that there were some. So I know it sounds really simple, but that was a dependency that's, quite acute in this business, but is something that I was willing to take on.
Well, Garrison, now let's zoom out a little bit. You mentioned Porter's Five Forces, so I do want to get to that now. But just before we do,
sure,
just speak to us about the evolution of your own sophistication at this point in the story, because you went from just a few years earlier not knowing anything about anything to then buying some real estate because that's what you heard people do.
Yep.
Deciding that wasn't great, still not knowing much about much. Buying a restaurant, So, but by the time you buy these two businesses, you're getting into a different league, I would say.
Yep.
Although still small businesses. And your analysis that you just shared with us was not so naive. I mean, you were looking at the risks and poking on the risks and seeing out, trying to figure out if one of your suppliers went away, how you would plug that hole. And so anyway, talk to us about the evolution, and you're getting smarter as you do this.
I hope I'm getting smarter. All I know.
But at this point in the story, because now you're super smart.
No, thanks. Yeah, I mean, I guess I would say that when we bought the restaurant, I thought I saw something good, and I had been reading a ton of Buffett and a ton of Berkshire. There's a Essays of Warren Buffett book that I've worn out, and I've got the complete financial history of Berkshire sitting right here in a book. And he kept saying, "Buy things you understand. Buy things you understand." And I'm like, "Okay, what does understand?" And he answers that in maybe the 2000 annual meeting. I've listened to every single Berkshire meeting on YouTube probably 3 times at this point, at least.
How many hours of content?
They're each about 4 hours, and the earliest I can find is 1990. Wow. I don't know, do the math. I drive a lot. But it's basically, he says, buy things you understand, buy things you understand. What does understand? I have a clear conviction, or at least a well-reasoned conviction about what the future economics of this business might look like well into the future. At least, if you're going to do it mathematically, maybe 20 years. So the question is, it's kind of like real basic, like what is in this thing that has made it stick around for so long?
Yeah.
Like it's already been around for a while. That's why I like old stuff. It's already been around for a while. Like, what is it? And until I can answer that question, it's not a mathematical question. It's a qualitative essence question. It's an investigative journalist question. Until I can answer that, I don't buy. And I really don't think I can price it until I do that. So at this point in the story, I'm looking through, I mean, I kid you, I mean, seriously, everything we've bought, except for our most recent 2 acquisitions, were listed on businessesforsale.com. So like I literally would just look at listings all the time, and I would scan it and go, yeah, instinctively, that thing doesn't make sense. It has nothing that differentiates it. Somebody could open up right next to it and do the same thing, and it has nothing to defend against that. I was trying to just go through very redneck, basic questions to determine whether I thought it made sense. And the restaurant, the thesis was basically this: it's a low price. The brand is worth that to somebody else in Nashville if we can't do it. And the people, based on where it is, the people and how long it's been around and the stories, and people love it. So if we have to ask for help, there's a lot of brand equity that hasn't been tapped. Let's try that. Wasn't much more sophisticated than that, to be honest. The manufacturing focus was, can I understand what these guys do, why the customers need it, how difficult it is for someone else to get into this business based on the people that are already in it. What do we bring to the party? Like, what do we compete on? And then what else is out there that might change this? Like, is there something out there that might make Babbitt obsolete, or might make suspension hangers obsolete, or in the case of our last manufacturing acquisition, portable racking systems obsolete? And I didn't realize that those are Porter's five forces. I didn't realize I was asking those questions, but to me, those felt like the most logical questions to ask. And I told my wife in the beginning, we're not going to buy anything that we can't liquidate every single thing that's there and sell it and at least pay off the loan we took out. So that criteria forced me into heavy asset stuff, you know.
And so another way of putting that is you buy it for less than you could flip it for the next, or excuse me, not flip it, but liquidate it for the very next day.
Correct. Yeah. Yes, correct. Or at least that there was such a like obvious, clear, like for instance, with New Deal. So we bought it for $900,000. There's 25 or 30 presses in there. There's inventory. Some of the presses are 500-ton presses, 20 feet high. Great machines. But the tooling, you'd probably need to spend about $5 million to rebuild that tooling. It's worth that to somebody. Does that make sense? Like scrap value, you probably could get $200,000-300,000 out of it. But like it is. I'm walking around looking at it, and I'm like, there are plenty of other contract metal stampers. If I told them, hey, I'll just sell you this tooling for $900,000, and it allows you to immediately compete in this line of business with maybe 2-3 other competitors in the whole country, you're going to walk into $2-3 million of revenue day one just by buying the customer list and the tooling. I thought that was pretty sound. So could be wrong, but there's a lot of things in that industry that might prove us wrong, but that was the rationale at the beginning. So,
well, Garrison, I love how I really think that that's a neat way of putting it, the investigative journalism. I don't think I've heard somebody else use that analogy. Also, the kind of qualitative analysis that you're doing here is, I think a lot of people come to this world focused more on the financial aspects of doing the deal and kind of the modeling, which is very intimidating and off-putting to a lot of people if they don't know their way around a financial model, which unless you have a finance background, you probably don't. You probably didn't.
Nope.
So what about that piece of your education, the quantitative to go along with the qualitative skills? Were you developing them?
Yeah, it's a really good question. I am self-taught in most of that, but I had a couple friends who helped me a lot. In 2018 and 2019. So I got to see, when I sold my marketing company, I got to see 2 other transactions pretty quickly that some clients of mine went through. They sold some big song catalogs, one to a very large pension fund, one to a private buyer. And my 2 good friends who brokered that deal used it as an education for me. And then the guys that bought my company, they also showed me how they did it. They showed me what their assumptions were. They showed me their spreadsheets. And then I just kind of sat down, to be honest with you, and said, all right, forget the colors, forget the formulas, forget the interest in precision. How can I just get on paper some estimates that are reasonable and conservative and directionally correct, that show me that if I buy this thing at this price, it's going to create some amount of safety for me. And in the beginning, that was just an estimate of liquid value, and then like possible strategic value. It's now basically very conservative discounted cash flows. You know, what's the present value of all the future cash flows out of this thing? I am almost 100% self-taught in that. And I don't know that that's a good thing, you know, but I have adapted it to just make it work for my way of thinking. But I kid you not, I sit on ChatGPT all the time and say, just teach me how to do this. Teach me how to do these things.
Financial stuff or everything.
Yeah. Mm-hmm. Yeah. And then I check it with some friends, but my financial models are not super sophisticated. So I lean very heavily on my assessment of the people, my assessment of the Porter's five forces, of the manager and their ethics, and basically the organisms that I'm getting into business with, the qualitative substance, and then really trying to get at the essence. Like, what are the elements that this thing has? like great example, New Deal, because they're small and because they compete in a really cost sensitive industry, price sensitive industry, they have this culture of radically low overhead. And I don't have to teach them to keep their costs down. They inherently are trying to keep their costs down because for the last 70 years, that's how they've behaved. That's really interesting and is definitely a really big advantage over time, right? So, I mean, like the fact that that's built into the way these guys work and just talk and behave is, I mean, that's an advantage for us. You don't find that you find indicators of that in the financials. You find like signals that might be there. And I'll say this just as an aside. One of the things we do in diligence that's very different, I allow every employee to come sit with me one-on-one and ask me questions. I also interview every employee that's willing about their view on the company. And all I'm trying to do is just build in my head a story of what it is that this thing is like on a day-to-day basis. How does it behave to its suppliers, its customers, its people, the community? What does it bring? What are we proud of? What do we think we do well? And once I get that, I then go look at the financials, and I have a couple key indicators. I want to see gross margins above 40%, ideally. And I want to see as high as possible of EBITDA margins. And then I want to discount that EBITDA by some future CapEx allocation, somewhere between 5 and 15%. And then I want to price it at above a 20% yield. So I want to be earning 20% off what I pay for it. So that's 4.5 times. And we've put out 38 million.
Sorry to interrupt, Garrison, but that yield number is effectively capping what you'll pay for it. So that's how you back out into a multiple. Like you're not going to pay more than 4x. Exactly. 4-ish x.
Correct. And I have...
Excuse me, 5x.
Yeah, it's 5x. But our blended... Our range actually is 1.5 for quad to 6, but there are qualitative reasons for choosing an 18% or a 16% yield on the 6x side. And I can tell you about that business if you want, but our average is 4.5. And we've put out, like I said, 38 million to do that at that price. And then last year our EBITDAs were like 9.2 as a group. And so, you know, I want to clip above a 20% return on invested capital. And then I want to recycle all earnings. So I want to put all earnings back in and keep all earnings and then reinvest them at the same rate. And I just learned all of that through listening to a ton of Berkshire, asking ChatGPT and Google to tell me what it means, and then asking my friends, just teach me the language of this investing thing. And I'm getting it. I'm still very young in it, but there's I think I'm getting it. And the financial piece, I don't really think it drives the boat. Like, I think Buffett said at one point, like, financial statements are not the territory. They're just a map. So it's like they're not the substance of the territory. They're just a map. And so you see signals of what it might be like and what the business might be like, but they're not telling you the reality of the business. It's the business that tells you the reality of it. And that's, for whatever reason, maybe it's the musician background or the interacting with people background or the music industry kind of DNA that I have. That's the way that I interact with these companies. So, and that's what gets me comfortable. I'm less comfortable making a decision just off of the financial statements. Although I have a very, very good friend who is a value investor in the public markets, ran for 12 years a $2 billion portfolio for one of America's largest, wealthiest families, earned 19% annually for 12 years, and doesn't visit companies, sits in a closet and reads annual reports. And he doesn't want to talk to the people. He doesn't want to talk to management, and he can make good decisions that way. I just can't. So that makes sense.
Well, it does. You've told us how you're an autodidact on this
very much
finance stuff. And how you've leaned on kind of qualitative assessment over quantitative while you bone up on the quantitative stuff. And it's a journey. You're not fully there yet, but obviously you know quite a bit. But now, if you would speak directly to the person who doesn't have financial chops, who's listening to this and is really intimidated by that piece of it. You've told us what you did is the answer. Do what I did, countless hours of Warren Buffett and just study. Or is there maybe a short, like reflecting back on how much time you've given this project? Is there a shortcut, or what would you say to that person?
Yeah, I would say that don't let, okay, so how do I want to say this? Buffett describes it as like the high priesthood of finance. He's like, you need to learn the acronyms and you need to learn the formulas in order to be in the priesthood. And I think it's ridiculous. I mean, there are a couple basic things that you need to know, I think, personally, about the assessments. And they are basically, if you're going to put money out today, what do you expect to receive as the years roll on? And what are you giving up by choosing that opportunity over some other opportunity? That is the present value concept. So the things that matter basically are how much money's coming in, how much do we keep after we pay for all the stuff that we have to have in order to do the job, what do we have to pay for after that, and why do we have to pay for it, office overhead and all that, like how do we keep that pretty low, and what's the final number, and then how much of that actually turned into cash and didn't just live on the accounting statements, how much of that's actually in the bank. I would say when they're doing diligence, go into the bank statements, take 5 years of bank statements, go through every single transaction, and just try to rebuild the P&L. Like just put inflows, outflows, reductions for the stuff that went out to the owners, and see how much cash is left over every month, and then put your debt service on it. I do that for literally every acquisition, and it's tedious. But I would say do not overcomplicate it. All you're trying to figure out is how much money's coming out relative to the money that you're having to put in, or the risk that you're accepting. So like I've personally guaranteed a lot of this money that we've put out. So I don't count this as return on Garrison's capital. I count this as return on the purchase price. What did I guarantee and what did I pay? Did you see how like what it's, to me it's as if I bought it all with cash in my mind. And
wait, I missed that point. Yeah. Can you say it again?
Yeah. So basically when I'm thinking about our return, it's going to be the net earnings number before depreciation, after you kind of adjust the depreciation thing a bit, divided by the total amount of money that was paid out, regardless of the fact that the bank paid it or the fact that I paid it or some combination. Okay. Because I'm guaranteeing the loans. And in my mind, like, I don't know. I know people would disagree with me on that, but that feels a little like common sense.
So whereas another investor might be like, the return on my investment, if I'm buying this business with an SBA loan, I'm putting in 10%, 20% of my own cash. So when I look at the cash that comes out of it, I compare it to that 20% of the enterprise value. You, Garrison, compare it to the entire purchase outlay. Price of the business.
The entire outlay.
And by the way, what that is for the audience is what you'd call the unlevered return on investment, as if you did it without debt. But of course, the power of leverage is that you get to amplify those those returns.
Well, the truth is, like early on, we didn't really have much of a choice. We had about $500,000 to work with, and we were trying to buy. We thought we saw a lot of great things, and we're trying to buy as many as we could. So we did, we took on significant loans as we went along. But I never wanted to pretend that I was, I don't know, in my mind, a better investor than I thought I was, because I had access to the SBA or whatever it might be. It's, and that is just straight from Buffett. That's just straight from Berkshire. It's like, when we get to the point to where we're able to take down a $20 to $25 million purchase in all cash, that's what we'll do. Like I won't use, if I use leverage, it'll be very, very, very small.
And so why? What's your opinion on leverage? It sounds like you have a philosophy there.
Yeah, I do. It's similar to Raphael's and those guys, but I just don't like how it makes me feel. Okay. I just don't like the fact that it sits in my mind as something that taxes my managers, it taxes the employees. Possibly it increases the possible existential risk for a business that I've told the family that I'm going to steward for the rest of my life.
Sure.
So
fundamentally, the risk weighs on you, weighs on your soul
Yeah.
a little bit, and of course it does put the business at more risk.
Yeah,
It's
for
a real
sure.
risk.
But I have chosen to have a real sensitivity to that because that's what the best do. Like the one I'm choosing to model myself off of, that's what he does. Therefore, that's what I'm going to do. And I guess the best way to say this is like, and he says it this way: it just makes me sleep better.
Yeah.
But I mean, our average interest rate for the loans we have is like 5.5. So I mean, we have really good cost of capital. Like, I'm not super tore up about the position we're in. I just would prefer to not have any of it. I'd prefer to be able to recycle all those earnings into another investment.
Yeah. Interesting how everyone has a different emotional relationship to debt.
Yeah.
Raphael and those guys, I've heard you say a couple times, and so the audience, anyone who's not clued in, whatever, a month ago, maybe a month and a half ago, an interview with Raphael Quinn, who buys businesses to hold forever, value investor, very much in the Warren Buffett vein, just like you, Garrison.
Yep.
So thank you for that plug.
Yeah, you're welcome.
All right. We've heard you mention also Porter's 5 forces now a few times. Tell us, please, what Porter's 5 forces is.
Sure.
Professor Snell.
Yeah, I'm going to try to be real redneck about it. But so Michael Porter is a Harvard professor from the 80s. He kind of pioneered this field of strategic management. Basically, if you're a manager over a corporation, there are competitive forces that you deal with regardless of the business. There are things at play that you deal with regardless of the business. There are 5 of them that he describes, and I would recommend his book highly. It's called Competitive Strategy, and it's a bit academic. ChatGPT can summarize it. I have it explain it to me a lot. But the basic takeaway, like the Business School 101 takeaway from Michael Porter, was there are 5 forces that every business deals with. How much bargaining power do your suppliers have over you? Meaning, if it comes down to it and you guys disagree on price, who's got more power? How much power do you and your customers have between each other? Does your customer have the ability to dictate that price, or do you have something they need so badly that you can dictate the price? How easy is it, or natural would it be for somebody to get into this business and compete with you? That's number 3, ease of competition. Based on the competition that's already in that industry, how intense is it? How much does it have to, like, is it a race to the bottom in all cases? Is there, like, what's the competitive set look like? And then what are the logical substitutes and alternatives to the thing that you do, that your customer needs? Alternatives is they're kind of the same way of saying the same thing, but basically, what else can the customer go get that you offer that you're not considering as a competitor, or you're not considering as a competitive offering? So in the case of Quad, our bearing facility, we have pretty significant bargaining power on the supplier side. If they decided to raise our prices 200%, we're going to have to scramble to find somebody else, and it's going to be difficult. You can offset that by ordering a lot more material at a certain price, tying up your cash in that material, by investing in product development, research development to get your own capabilities in-house. You can go to somebody who has the capability but isn't in that line of business and set up a strategic partnership, which is something we've started to do. But as it stands today, and as it stood 4 years ago, that's difficult. That's the weakest point of that company. On the flip side, though, the customer doesn't have many alternatives, and it gives you some significant bargaining power. So when the customer has a certain pain point with that business, they need 10 very precise bronze bearings that are critical to the operation of this oil drill. They don't want to import them. They're really concerned about quality because it's going into, say, a government application or something. They can't bring them in overseas. We need somebody who's going to do that. There's really only a couple companies that do it, and it's mainly because Babbitt is kind of hard to work with, and it's kind of a foreign substance, and that level of precision is really hard to get. I've taken those bearing designs to one of our other companies that has a CNC division and said, "Can you guys make this?" And they said, "If we got that, we would no quote it. We can't make that. The tolerances are too tight." Quad happens to own some machines from World War II that allow them to do that. And it's kind of mind blowing that technology from that era would allow you to do it, but it's one of their competitive advantages. It gives them bargaining power. Nobody's getting into this business. Like, very few people are gonna go and try to figure out how to work with Babbitt. It's a hot casting process. It's kind of intense. And then try to figure out that precision, that level of precision from a customer expectation. They're gonna have a hard time with that, and they're just gonna pass on that revenue stream. They're just gonna say, forget that. And the folks that are already in it have a real nice oligopoly. So there's only like 3 other companies in America that deal with Babbitt at all in any application.
Wow.
And from what I've found. And some of that is repairing big bearings, some of that is making big bearings, some of that is casting it. But the competitive set is already pretty small and balanced, and it's unlikely to get much bigger. And the substitutes are interesting, but they're not things that we couldn't adapt to. For example, certain bearings, and I had to learn all this. Like, this was part of my diligence process. This is how I think about diligence. Part of the things that exist out there that are alternatives to Babbitt or substitutes for it are ceramic bearings, silicon bearings, and certain other types of chemical compounds. The difference is they're all pretty extreme in price at this point, which defeats the purpose of why you're buying Babbitt in the first place. So it would perform the same function, but it would not like it would eliminate the price. Like, Babbitt's the best alternative all in. Now, if ceramic improved and the ability to produce a ceramic bearing improved and the price got dramatically cheaper, we would then have to go and adapt to that and start producing ceramic bearings. Does that make sense?
Yeah.
But it tells you the vectors on which you're going to need to compete. So I look at everything through that lens, and I look at it really quickly. And that's my initial screen and filter for every company that we look at. And it's why most of our, if we have, like I said, 5 companies at this point, it's why most of them are classified as a small piece of a big thing, because there's usually bargaining power in that. And in most cases, they use a material or a method or a process that's easily, they basically, like, you can get from a lot of places. And there's already a pretty nicely balanced little competitive set. And it would be hard to get into it if you wanted to do it. And there are very few practical substitutes or alternatives for what they do. And
when you say a small piece of a big thing, what did you mean by that, Garrison?
So take the trailer business. It's a couple brackets and equalizers that is one part of a very large trailer project. So the guys that are fabricating trailers are taking probably 20 different material types and welding it together quickly to get that trailer out the door. All we're doing is selling them the brackets and the equalizers that go on the axles and the mounts. Like, it'd be, the bearings are very good example. The customers on that end are building or repairing large industrial equipment, power equipment. We're selling them a piece of that. Our racking business sells portable stacking racks, which are modular racking for moving weird, hard to handle material types around. So, like coils of steel, carpet, tires, pipe and tube. When customers are buying that, they've also spent, let's say, 10 times or 5 times what they spent with us on the structural racking that goes into a distribution center. So the guy that's in charge of buying all the racking is spending a lot of money on the structural racking and a small amount of money on the portable racking. For us, it's more about quality and delivery than it is and service levels than it is about price. So you get a little bit of pricing power by being the small guy. Does that make sense?
It does, and it reminds me of a theme that comes up again and again. It's where you particularly common in manufacturing, where you want to be the widget that is low price, high essential, highly essential, but low price.
Yeah.
So when your customer is looking at their, all their expenses and all the things they're spending money on, and they're feeling tight or whatever, and they need to go out and negotiate prices down, you're so far down the list that they're not going to get to you, or it's not even worth their time because it's a really small expense. It's funny how often I find myself saying that, because it's a phenomenon that seems to come up, at least in high quality businesses, again and again.
Yeah. Our CEO, so I hired a gentleman 2.5 years ago to run the manufacturing group. And he comes from Illinois Toolworks, ITW, which is a massive holding company of industrial businesses. They own 860 something individual manufacturing businesses, all of which are about 20 million of revenue apiece. So very decentralized, very small companies. He's 55, and he likes to talk about the long tail of stuff. You Pareto it out. You've got all the stuff they concentrate on up here, and then you get all this little stuff down here that's just, don't hold up the project. Just get it to me on time and get it to me right. That's what I love. I love that. And so Porter's Five Forces is just another way of accessing the same conclusion.
Running a business through Porter's Five Forces, it's a good forcing function to make you understand the kind of qualitative nature of the business and where. Yeah. I mean, that's the point, is that it's an exercise for you to make sure you understand how not what's going on in the balance sheet or cash flow, but really the forces that are acting there. It's really powerful. One of the things, Garrison, I would want to ask about this is, like, you're an investor first and foremost, like Quinn, like Buffett. So you're just waiting for fat pitches, I assume. You can look at sim after sim after sim. Yeah. You don't feel compelled to act when everything isn't perfect.
Nope.
And so therefore you probably have a higher bar than maybe a searcher who's got a runway and they're really looking to just move on with their lives and buy and own a business and start operating. So where I'm going with this is that a lot of the businesses that my guests would buy probably would, quote, fail Porter's Five Forces, or they'd be quite vulnerable in one or two of according to one or two of the forces. Home services being a great example. Yep. So if I buy a plumbing business, the competitive environment is terrible.
Yep.
What are some of the other things? So the price sensitivity of my customers, I can't just double my prices because they'll go elsewhere. And I'm probably forgetting others.
No, you're right. You're right. That's why I've stayed away from those historically. I've had a hard time getting around a really unique, good home services company, for example. And I've looked at them. I have a hard time with them.
For this very reason.
Yeah, for this very reason. And I'm not saying they're not great businesses for an awesome operator. I just don't look at it as an operator.
Yeah, right, exactly. So I guess, the takeaway for the audience is, or for the searcher, is it's a really valuable exercise, but it might be too high a bar, frankly, to pass if you're looking to get in there and own and operate in the next year or two. Garrison can wait for that fat pitch and for that business that nails it on all five forces. But maybe the person listening can't.
Well, I'd say that's probably true, but none of our businesses are perfect in that. Okay, so like we've every one of our businesses has some deficit along one of those vectors, and the cool thing about great management is that they can go and find some way to smooth out those vectors or solve for it or defend against it. Yeah, there's a reason in our marketplace here in Nashville, there are 3 quite large home services companies, all above 150 million or so in revenue. They compete ferociously, but there's one in particular that has developed some great value propositions that makes them a lot stickier than somebody else, and that's why they're the leader. That's you want to, as an investor at least, I want to find a manager like that. I want to find an operator like that. But I would say maybe like Porter's Five Forces might just be a little bit of a look into a crystal ball of what you're going to deal with over time. Mm-hmm. And so if you're a searcher and you're like, hey, I'm going to go buy something, it might just help you be clear-eyed about the dynamics of what you're going to be in for the years that you're in it. And that's okay if you can operate it, if you can be successful in that, like rock and roll,
Well, and 2 points on that. It's kind of like if you see that along one of the Porter's Five Forces vectors, it's weak, but many businesses, like you said, all businesses are probably going to have some weakness along one of those vectors, if not more. It's kind of like a pick your poison thing. It's like, can I handle, for example, if you're comfortable being in a really competitive market, and so you're looking at a business that has that, quote, weakness, you're fine with it. That's an environment in which you're comfortable. So it kind of surfaces to you the poison that you're going to have to deal with, and then you can
That's right.
decide like is the pain of this particular business one that I'm more comfortable with than the pain of that business over there.
Yep.
First,
That's right.
second, this seems like a really valuable exercise to identify how you can add value to a business. So if a particular business it performs really poorly on along one of these vectors, and you feel like there might be an answer to that or a way to improve upon that, it's another way of surfacing how you can get in there and make the business you're buying a stronger business and add value to that business. The way we typically do this is we just kind of, look around and, oh, they're not doing digital marketing. Let's do digital marketing. Oh, they don't have they're not direct deposit to their employees. Let's implement that. All those things are great and are often low hanging fruit that can move the needle quickly, but they're not. There's not a strategic framework there, and maybe Porter's Five Forces could be that.
Yeah, it helps us not guess on where we need to invest effort. I'd say it's very true. Buffett said, I can't remember, it was 2002 maybe. He said, somebody asked him what's the best business he's ever seen, and he said the Harvard Business School. And he said, if you drop prices, demand goes down. You raise prices, demand goes up. That's a pretty great business. And if you run it through Porter's Five Forces, okay, let's just run it real quick. How much power do you and I have over dictating what Harvard charges us to get an MBA? Can we influence that at all? Zero. We can't influence that at all. How likely is it that somebody's going to set up a true alternative or substitute to the Harvard Business School MBA? If somebody wants to set up a new university and just compete directly across the street, what's the likelihood that they are going to make any progress in the next 100 years on that? It's pretty low. How many folks are competing with Harvard, really, the Harvard MBA, truly, today? Wharton, Columbia, maybe like a London School of Economics, maybe, but like a small handful. And the one place where they might be somewhat weak, but have done a really good job by being Harvard, bargaining power of suppliers. Who's your supplier? It's the teachers. It's the talent and the professors that you're attracting in. There's a good chance that the very best of the best, like the Michael Porters of history, can dictate a higher price because you need them to make that MBA worth something, but they kind of need your platform too, right? You see what I'm saying? Yeah. I mean, even Harvard, which is the best business that Buffett said he's ever seen, has a slight deficit in the fact that it needs certain key suppliers in order to be what it is. Does that make sense?
Yeah.
So it just tells you on like the vectors on which you could invest and what you might.
As you were going through that exercise, I on probably 3, maybe even 4 of the vectors in my mind, it was like, well, the brand is so strong here.
Yep.
That's why that's what gives them the negotiating power with suppliers. That's what allows them to charge students, and students will pay anything.
Yep.
And so that probably goes to why brand is so valuable. And Buffett has said, like, he'll just pay for brand because brand straddles a number of those vectors, and it just gives you power across a number of those vectors.
I mean, that's what a good operator can build. Like a good operator can take the raw material and build that, Cool thing about being an investor is I get to pick from all those great stories about, which ones I want to put capital into, but I can't do what a great operator can do and build something like that over a lifetime,
Garrison, we're pushing up on time hard, but I still have 2 important things I want to do with you. If you'll give me the time, if you can't, let me know.
No, I got plenty.
Awesome. The first is to finish out your story. So, and we're going to have to do that quickly, unfortunately. And then I want to just hear, take a look under the hood of what your life is like, because it's not all just moving, the chess pieces around. You had a hard day, as you told me right as we got on the call, and so we'll just want to hear about that. It's not as glamorous as it may always seem. So first, can you kind of bang through the next 3 acquisitions?
Yep, we did our 3rd acquisition in the summer of 21. We paid $9.9 million for the real estate and business of a very large, quirky job shop in Columbia, South Carolina. They basically offer 6 different six different manufacturing services in one business. They're the largest non-captive metal stamper in the state of South Carolina. CNC, tool and die, machine rebuild, custom automation, aerospace stamping, all under kind of one roof. It's a very unique offering in a very popular area. So we bought them, and then we acquired what we believe to be, but it's hard to know, but at least the top three leading domestic producer of what are called portable stacking racks, which I talked about earlier. It's a company called Tier Tier Rack out of St. Louis. And they make basically custom racking systems for shipping and moving around and distribution for stuff that's hard to put on a pallet. So Walmart uses them for Christmas trees, and Goodyear uses them for large agricultural tires, and Lowe's uses them for lumber. And it's, we use them internally for coils of steel, and they're used in nuclear waste facilities. It's like you got to move stuff around. It doesn't all fit on a pallet. And so you need a custom solution for that, and that's what they do. And then we bought a company whose name I won't mention because it's been asked that I don't, but they're one of the leading managers of medical trusts for paraplegic families in the country. And it's a fantastic family business, second generation, and we are partners with the family in that. I own 100% of the equity in everything that we own at this point. Except for that business, we own 80%, and the founding family owns 20%. So we buy one or two companies a year, and we usually are looking for at least a couple million of EBITDA. The biggest I've looked at is like 15 million of EBITDA, meaning that I've actually was pursuing and could close. I'm looking at one right now that's about 5 million of EBITDA, and that's kind of the range we're in, and we try to do one or two a year.
And so tell us what the aggregate revenue of the Holdco is today, and EBITDA, if you would.
Yeah, end of last year was 37 million as a Holdco, total, and EBITDA was 9.2 roughly. It's like right in that ballpark. And the rental properties are not big contributors, obviously, but the major contributors are the racking company, the company out of South Carolina, and then the trust company.
And where do you think you'll get in at the end of this year?
I don't know. It
depends on if you do another acquisition.
It depends on another acquisition. The racking company is we knew this going into it. It's a boom and bust company. It has really high highs and really low lows. We're in a low right now. We just got confirmation that we got a large, almost $3 million order last Friday that'll probably take us to another high. So you never know with that company. But if we do another acquisition. If we do the acquisition, I think we could do this year. I'm visiting it next Friday. That will put us at, using last year's numbers, that'll put us at about 60 of revenue and 15 of EBITDA, roughly, thereabouts. Mm-hmm. So, and that, like I said, if we can do one or two of those a year, it's a good thing to do. So.
At age 30.
Yeah. Yes, I turned 31 in July.
And this is what you intend to do for the duration of your life.
Yeah. I mean, unless I can find something better to do, meaning some other way to help and do something contributory. But I see it as personally like an honorable thing to say, we're just committing to this great family business that we're going to hold it for the rest of our lives. I mean, so the racking company, they had 2 private equity offers, and our offer was about 6 million below the largest private equity offer. And they picked us because of what we do. And there are sellers out there who that really matters to. So that's kind of why we're in the marketplace.
And Garrison, how do you convince sellers that you have this approach, this philosophy? Because you could imagine people being skeptical of it. You could imagine a seller being like, "This guy's saying he's trying to help the world, but maybe he's a shark." So how do you really prove it to them?
Well, the first thing I do is I try to communicate it as authentically as I can, but 2, I let them diligence me. So we have annual reports of everything we've given and to what we've given to and the programs we run. And then I encourage all the selling families to call the employees, call the plant managers, and just ask. I'll give them any reference they want to talk to, if they want to talk to former sellers, whatever it might be. Let me be honest and clear. Let me be very clear. We have not been perfect in this at all. Systemically, we're a young company, and we are getting systems in place to make sure we do what I want to do right and authentically, which has led to part of the frustration and pain of the last couple of days. But there has not been any doubt, or when people sit with me and they look at our not just our what I say, but the track record that's well documented, they truly believe like he's actually trying to do that. And then they may ask the question of like, am I willing to let him go through the bumps of growing into it with my business? You know, so like typical alternative that we've noticed to us is an ESOP. So people might look at us and then they might say, well, they're a little young or they're a little new or a little unproven. We love what he's trying to do and we love what he has done, but maybe we'll sell it to the employees instead. But I just do the best I can. I mean, I tell them what I'm willing to do and I let them talk to anybody they want to, and I hope that they'll tell them the good and the bad, you know, and then just let them take me from there. So.
Okay, Garrison. Well, tell us a little bit about the getting your hands dirty that you had to do the last couple of days, why it happened, what's happening, and why it's not just all moving money around all the time.
Yeah, so we have this business that's they're just super passionate people, very, very lovely people, and culturally they believe very strongly in what they do. They have very high standards. When we acquired them, we wanted to institute some services and some features to them that we thought would be really, really good. And we told them, hey, we're not going to make any changes to your business that are not accretive and positive for everybody. We're not going to force something on you, which that's our way of doing things. Well, we implemented a bunch of changes, healthcare, new handbook, direct deposit, some things that, you know, some very basic things, and had no idea that the net result of that was a lot of pain and confusion and I guess the feelings of abandonment and cynicism and bitterness towards us because we didn't communicate it well, manage it well, like ease it into the process. And so I had in a plant 2 days ago, the entire workforce walk out and got a phone call saying, we can't handle this anymore. And I had no idea what they were talking about. And so I had to parachute in. I did parachute in immediately, got in the car with our CEO, went in there, spent 5 hours with the plant team, hearing everything, and realized we did a really bad job of delivering on the leadership feeling, the smoothing of the transition, the smoothing of the transition. Everything we did have the result that we wanted. It was going to be a net positive, and it was a net positive. We didn't integrate it well at all. And for whatever reason, the primary thing that I need to do better and have not done well over these years is spend enough time in the early years with the teams. I really lean heavily on the operators at the plants to make 95% of the decisions, and our CEO to do that. But they need to feel me. You know, they need to feel our culture and our why. And I'm not there regularly enough for them to feel that. And I realized that, like, if we're going to do things that we know are net positives for these folks and that they want us to do, they've asked for, and we're not going to follow up on the implementation, we're not going to manage it to the last minute, and that I'm not going to be there to take the bullets, that's going to be really hard. And so I just realized I don't have and this is something we have to have, an early warning system, you know, like a tornado warning system for what's going on at the plant levels related to the fact that we bought the company. It's usually just like, hey, we're gonna offer you guys a better deal on your healthcare by joining the group plan. Okay, that requires some administrative changes. It's rife with the opportunity for hiccups and potholes and distrust. So what we have to do is we have to handle that with kid gloves. Well, we just kind of did it and then didn't really check in, you know? And so I had some folks who had been working there for 20, 25 years who were just like, what is happening? And nobody called me. And that really bums me. So I don't know why. And I found out over the last couple of days that basically they don't feel like they know me, you know? And so I am now committed to being at that plant at least every week, if not every other, if not more frequently. I shared a lot of my personal story and my family background and things with them. Spent a lot of one-on-one time with them. And the key thing in my mind that I have to do in that situation is not be defensive. Like it's my fault, and there are things that they could have done different. There's some folks that are culpable in this. That's not the point. Like the point is we screwed up and I screwed up. And so it's very, very important for me to be there, own that, hear them out, write it down, follow up, deliver on it, and then make sure my team feels the same level of expectation. So it's just, honestly, I'm chalking it up to being young. The fact that we are new in this system of integrating companies, and we have not had this one before to this extent, to this extreme extent. The main reason it got so extreme was because they didn't feel like they were being heard, and there was a communication channel right above them that was blocking the news from getting to us, and that's a big deal. So I have had to go through and kind of break that the last couple of days, and we will. It seems like I called up there 3 or 4 hours ago, and they said it feels real normal today. Everybody's in good spirits. What you did yesterday was really good work, and we'll. I'm going to be out there next Wednesday, and then we're just going to keep moving. So it was a long couple days.
How did it feel? Were you panicking at all, or were you mostly disappointed, and or what? What was the emotion? Because you're big enough now that this wasn't going to be even an absolute disaster. Wasn't likely going to be a fetal position moment for you as it might be for a searcher who bought their business and is looking at a mutiny. You're big and diversified enough. Maybe I'm wrong.
I don't feel like we are. Yeah, I don't feel like we are. But I also look at every business as an individual commitment to a family and a group of employees. And so if to me, it's like there's no excusing my disappointing them, regardless of size or commitment. It's as if it's the only business I own. And that's the way it should feel. No, I was terrified.
That's great perspective.
I was absolutely. That's a Buffett thing, It's so. But I was absolutely terrified, and very, very, very focused. Like the way we are set up is that my leadership team in Nashville and Ohio is where we have our COO for the manufacturing group. They are in charge of everything that goes on in the facilities, and the people just below them are in charge of those facilities. Okay, so it's very decentralized. I only spend my time mostly on acquisitions. Basically, if we're going to run that, then I have to trust completely that the folks below me and the folks below them are going to make the same types of values-based decisions I would make. Well, we're still really young with a lot of these people, and so sometimes they make decisions that they think are best, but are maybe a old school way of doing it, or a fear-based reaction, or they may react in a way that doesn't align with our values, and that's what happened. And I'm not doing a good enough job of communicating why we do it, how we go about things, and then being there to model it. Does that make sense?
Yeah, sure.
So I was terrified, and I said, drop everything, get in the car, we're going, and we're not going to leave until I'm gonna pour my heart out to these guys, explain to them our intentions, hear everything they have to say, honestly and perfectly, not question it, not defend myself at all. And then ask, what can I do to help? Like, what can I do to fix this now? And it really galvanized our team, and we realized, we've got to do this better next time. So, when I called up there today and then talked to a couple of the other leaders, they were like, "You really did a great job of making us feel better yesterday. Thank you for coming. Thank you for taking action. Thank you for being here." And it seems like we're okay right now. So we still are probably going to have some people who leave, but if they do leave, they're going to leave because they're honoring a commitment to a new job, and they're going to feel a lot of respect towards the way we've handled the cleanup. So there is a leadership change that'll have to be made, and there is there's some other like key things that'll have to be done. But I just felt really sad that it got to that point that I didn't know, and that the system kind of failed to deliver on our values.
Yeah.
And that it won't happen again. Well, I mean, it
Yeah.
may happen again, but there's a couple things I'm doing differently to monitor what's going on that I haven't done in the past, just to make sure that we get ahead of these things before they, become unhealthy.
Yeah. Well, Garrison, it sounds painful, but that you deserve congratulations for the action that you've taken and how you've handled it. And of course, the silver lining, I guess, is that you'll look back at this in 5 years and it'll be a key moment in helping you in your own learning about how to communicate values up and down the organization and how you make Snell Ventures that much more robust and long lasting. So some of this stuff has to happen to stress test the apparatus of the Holdco. And then you emerge on the other side stronger and all that.
Yeah, I was in my YPO forum earlier today, and one of my buddies in there was like, "Yeah, this is going to happen eventually, dude." He's like, "It's a good thing it's happening now," and I'm like, "Yeah, you're right." It's reorienting for everybody. They realize like, oh, we slipped a little bit. We will. I mean, look, I view this as a permanent stewardship commitment to these people, their families, and that town. And so if we say we're here to improve your lives, we're here to do things for you guys that no other employer does, and there's a lot of those that I could talk about, or that most employers question whether it has economic value or not. And I just think it's a good human thing to do. And then we go and make their lives harder, or miscommunicate, or are heavy-handed with them, or like abrupt and dismissive. I mean, it's just very, very jarring. And the truth is, a lot of our employees have already had experiences with management in the past where they feel that management may not be trustworthy. And it is one of my deepest desires that they feel trustworthiness from us and dignity because of what we do for them.
Yeah.
That makes sense.
Yeah.
And
yeah.
So that's what got me upset, was that we failed in that mission. And
Yeah.
But this is exactly what every owner that I've bought from would do. And so I'm just trying to do what they would do. This is the kind of principled nature of what they've done this particular company has been around for a long, long time. And that last owner had a really hard 2008 and did some really virtuous things for the employees during the 2008 setback. And we're just trying to do what he would do. So, does that make sense?
It does. And we're going to have to leave it there, Garrison. Thank you for sharing that bit of
it's real life, man.
Painful. Yeah.
Real life.
Well, it is despite us ending on a bit of a down moment here, it's a remarkable what you're building, how early in life you're doing it. It's really going to inspire people. Thank you for the education on Porter's Five Forces.
Oh, yeah.
I've been exposed to it. It's actually taught in the acquisition lab. So Walker Dybel
cool.
And Chelsea Wood, it's a big part of the instruction there. But I haven't actually heard it come up much since I did the lab over 2 years ago. So I was rusty, and it's such a valuable tool that it should be talked about more. So thanks for the education on that and for sharing. How can people get in touch with you, Garrison, if they have questions, want to say hi, want to say congratulations?
Yeah, a couple ways. Our office line does come to me and to another person. So it's, so it's 615-682-3412. Feel free to call, leave a message, or send a text, and I get that. Then my email is just garrison.snell@snellventures.com, and it's really easy. So just holler at me. I love getting messages from folks who are trying to do this, and have helped a few people with acquisitions recently, specifically in structuring their financing or putting the deal together or something. So if there's anybody that needs it or wants to talk about it, I'm happy to discuss it with them. So,
well, you're talking to the right crowd, and there probably will be a lot of inbound from that invitation. So very generous of you, Garrison.
Yeah, happy to do it.
Thanks for giving me so much of your time and coming on today.
Yeah, dude. Thank you.
I hope you enjoyed that interview. Make sure you subscribe to the Acquiring Minds channel below. We are now publishing twice a week, so tons of new interviews and stories to come. Stories that will help you along your own path to acquiring a business.